Hello, this is Brian Rezny, President of Rezny Wealth Management and host of the Rezny Wealth Report. Make sure you visit our website, ReznyWealth.com, download any of our groundbreaking reports, instant download, and they're free. We've got some great topics for you pre-retirees and retirees today, ways to protect your retirement portfolio, and ultimately understand the economy and how it affects your retirement. The U.S. economy really is a dynamic, complex system that impacts really everyone, but retirees are often impacted the most. And why is that? Because recessions happen. And let's talk about a recession, because that's often a topic that scares many retirees because they fear their portfolio going down in a recession, ultimately often to come right back. So what is a recession? A recession is a decline in economic activity. Recessions don't last very long, folks, often 9 to 12 months, and that's it. Think about a recession like this. You're going down the road doing 65, that's the speed limit. You push it to 75, all of a sudden you see a police officer, you slow down, and often under the 65 limit. That's a recession. Within a few miles, you get back up to normal speed. That's the U.S. economy coming out of a recession. 9 to 12 months on average. Realize that that's the typical recession. Now, what happens to investments in a recession? Many investments will go down in value, again, temporarily. Most investments, whether it's the stock market, the bond market, gold, real estate, oil, doesn't really matter. Most assets will experience volatility in a recession. But again, it's short-lived. What causes a recession? Often an overheated economy on the short term. So again, where things basically rise a little too quick, and then things basically come back under the speed limit, only to go back to the speed limit or higher down the road. So remember, recessions are not to be feared, they're to be embraced, and that's often an excellent time to really upgrade your portfolio. Because remember, your portfolio is not a static instrument. Your portfolio is made to be adjusted when appropriate. And often what you find in a recession is certain assets may go down more than others temporarily, but spring back much quicker, giving you the opportunity for outstretched returns. Rob in Naples, Florida. Small caps versus large cap U.S. stocks. What do you expect going forward for the next 3 to 5 years? Rob, one of the things I want to stress is, there's two parts of the market. There's smaller companies and there's larger companies. And one of the things I think you need to look at today is large cap stocks. We are in an economy that has a higher interest rate cycle right now. Small caps usually will get hurt and languish and have underperformance. I do not see interest rates coming down anytime in the immediate future in the next 3 to 6 months. If that is the case, small caps will probably continue to underperform large cap. I like large cap. We're predominantly at Rezny Wealth Management invested in large cap equity exposure right now within the U.S. In the next 3 to 5 years, if you're properly positioned, I think you're going to be a richer person in the next 3 to 5 years. You'll have volatility, of course, along the road, but in the next 3 to 5 years, and I like that you're looking at a longer term time frame, you'll be well rewarded by investing in large cap growth equities in the U.S. That's our opinion. Russ in Cape Coral, Florida. Which investment sectors have a better chance to outperform others, say healthcare or oil? Russ, you know what? One of the things you want to look at is not that this is always the case, but look at policy. Again, depending who's in office, policies do matter, of course. So oil, let's hit oil first. We are actually at the point at our firm, we're starting to reduce our oil exposure. It doesn't mean we completely don't like oil investments, but we actually had a pretty high sector weighting in oil the last 3.5 years. Under the Trump administration, we did not own oil because the policies were for energy independence and cheap energy prices. Then Biden came along, and his policies were bad for, of course, cheap energy prices, and that's why you've seen the inflation impact we've seen in the last 3 years now. We actually started buying oil after Trump lost the last election, but we're actually at the point now we think things are going to change as we get into November. We've owned an overweighting in oil. We're trimming positions. We actually do like healthcare, and we own positions in that too. I think ultimately what you need to do in your portfolio is look at sectors or investments that have higher growth of earnings. Remember, earnings drive price. So if earnings are growing quicker, often those are growth areas of the market, and often growth stocks in those areas will perform better than stocks that are making lesser earnings growth. Dennis in Fort Myers, Florida. Recently retired are you and are interviewing advisors. So far, 2 firms we talked to are both pushing annuities and claim to be fiduciaries. What gives? Dennis, the word fiduciary is worthless. And let me explain. There isn't a brokerage firm, bank, or insurance company today that doesn't do fee-based work. They can claim fiduciary status, but none of these firms are fee-only fiduciary money managers. You want a firm that is fee-only fiduciary money manager, and you need to get it in writing so they don't blatantly lie to you. I've had clients hire my firm from some of the big banks or from some of the brokerage firms or one of these annuity charlatans that you'll go into their office and they'll say, we're a fiduciary office. That's not a fee-only fiduciary money manager. Fee-based is not remotely even close to fee-only. And unfortunately, when people hear the buzzword fiduciary, they think that means fee-only, and it's not. What I would suggest is go to ReznyWealth.com, click on our special reports tab, and for free, download Real Advisor, Fake Advisor. It explains the difference between fee-based and fee-only. Get it in writing and protect your wealth. And by the way, you're more than welcome to call my firm during the week, schedule a consultation if you want to discuss our money management, because Rezny Wealth Management is a fee-only fiduciary money manager 100% of the time, and we always legally work in our clients' interest 100% of the time. I'm going to take a quick break. As always, send your questions to Brian Rezny at ReznyWealth.com. I'll be right back after this. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program. And one of the things I stress to every investor, make sure that your money is being well treated. Make sure the advice you're getting is real advice and not sales propaganda. Don't buy investments that ultimately are going to harm your portfolio, because sometimes you can't make up those steep losses down the road. Retirees' investment mistakes, and I want to talk about this because one of the things that's challenging for all of you out there, especially retirees, is avoiding the common pitfalls and making sure you're doing the right things with your money. So what are some of the major mistakes I see retirees often make? Failing to diversify. Number 1, over-reliance on a single investment type exposure really gives you unnecessary risk in a portfolio for retirement. Solution: diversify across classes, stocks, bonds, real estate, to mitigate some of that risk. Now that doesn't mean you do dumb diversification. You don't over-diversify. You properly diversify in areas of the economy and sectors that are showing relative strength on price performance and relative strength on earnings performance. Those are great attributes when you're building a portfolio and diversifying. And the other big thing is don't be too conservative or too aggressive. I will often talk to people that are retiring at age 65, and they'll say, well, should I get more conservative now that I'm retiring? And I say, absolutely not. Your risk profile should be in line with your goals and objectives. Just because you're retired, just because you're 80 or you're 40, doesn't really dictate a certain risk level. Your risk level is up in your head. Now that doesn't mean you want to be aggressive and do all kinds of crazy speculation investments, but your portfolio should be designed around what's called total return. Growing your retirement assets, growing your retirement income so you can combat inflation, which is going to be a big issue for a lot of retirees. Retirees often become overwhelmed and cautious and miss growth opportunities, and I talk about this all the time. If you're excessively aggressive, again, that's a problem too. So don't run out and buy things like Bitcoin. That's a speculation. Don't buy all your money in lotto tickets. Again, that's speculation. Don't go to Vegas and gamble everything on black. That's speculation. A well-balanced portfolio will balance the risk and often give you that total return objective you need in order to build your portfolio for future growing income needs. Remember, if you're 65 years old and you're married, there's a high likelihood one of you is going to live well into your 90s. That's a long-term retirement. If your portfolio is not growing your retirement income, you're going to basically spend down capital and you're going to be in deep trouble down the road. The other big one is falling for scams and fraud. One of the things that seems prevalent today is more scams and fraud than I've ever seen in my life. I've been managing money over 35 years. Fraudulent schemes promising high returns can be devastating to you retirees. One of them that jumps on the list, annuities. Equity index annuities that promise free money bonuses is a scam. Watch out for these. And these are often pushed by these free steak dinner seminars at a fancy steakhouse by a so-called advisor who, again, is not a fee-only fiduciary money manager. Solution: stay informed, verify the investment opportunities, consult a real advisor. Make sure you get it in writing. The other big issue is ignoring tax problems when you invest your money. Often, people will neglect to do tax planning, which we feel very important at Rezny Wealth Management, will erode your retirement income. What are some of the solutions? Understand the tax-efficient withdrawal strategies and seek professional advice if you don't understand what to do. Remember, taxes do matter, and many investors, unfortunately, do not look at taxes when they buy their investments or when they change an investment. Remember, every time you buy and sell could create a gain and or a loss in your portfolio. That's going to impact your taxes. Will it raise your taxes? Will it lower your taxes? And ultimately, what should you be doing with your tax scenario around your overall portfolio and your retirement? Tom in Miami, what are your top sector picks right now? What signals do you look for to decide when it's time to jump in or out of a sector? Tom, excellent question. So generally speaking, healthcare is one, technology is one of our top sectors right now. As I made a comment earlier, one of our top sectors was oil, but we're starting to trim positions in that and take some pretty significant profits. I think investors need to realize change is important when it is necessary. So there could be times we own a particular sector for years and years and years, or maybe a decade or longer. And there's times we may buy a sector like oil that, because of policy from one administration to the next, gave us opportunity, and that opportunity may be starting to evaporate and go away. So again, look at where that sector is headed. What are the opportunities for that sector to continue in the right direction? And those are the sectors often that are going to have earnings growth, which then often leads to share price growth. Larry in Naples, Florida. Why do you recommend ETFs? My advisor is using mutual funds and stocks. ETFs, Larry, are a better tool in the toolbox. Your advisor's recommending mutual funds because your advisor is not a fee-only fiduciary money manager. Your advisor probably clears through an independent broker-dealer or works for some broker-dealer and basically uses mutual funds, even in a fee-based account, because they get revenue sharing, shelf space fees, and they get allocated 12B1 fees, things of that nature. ETFs don't have all the crazy expenses that mutual funds do, and or the kind of conflicts that mutual funds are often prevalent in the type of relationship you're dealing with. So think about this. If you're going to pick out a tool out of the toolbox to use, you pick the best tool. ETFs, in our opinion, are cheaper, most cost-effective, and a substantially better option to build a portfolio than mutual funds. Maybe it's time you stepped up, found yourself a real fee-only fiduciary money manager. You're always welcome to call Rezny Wealth Management and discuss our services. Adam in Naples, Florida. What are your thoughts about a 60% allocation to bonds and balance between equities and alternative investments? I'm 67, and the last 2 years for me is less than 2.5%. Not good. So at the end of the day, Adam, this is what I'm going to say to you. You're allocating way too much money in bonds. What I would suggest is this. What is your risk strategy, number one? What is your risk profile, number two? So if you're trying to reduce risk and you're trying to get a return on your money and reduce your overall risk profile, Are bonds really doing that for you? Having an allocation that much to bonds, given how rates have run up so much in the last, let's say, 3 years, has really harmed your portfolio. I think what I often see investors do is they will allocate a bond position or percentage based upon their overall age. That is not necessarily the best way to go. So just because you're 65 doesn't mean you should have 60% in bonds and 40 in equities. There's times you want to have very little bond exposure and maybe more cash. Remember, when interest rates go up, bond values drop like a rock. And depending what kind of bonds you own, duration, type of bonds, quality of bonds, is going to have an impact on really the value of that asset base and the overall total return you're going to receive. In general, bonds have had a horrific last couple years, and I don't see that changing a lot in the future. Go to ReznyWealth.com, click on our special reports tab. As always, if you're not happy with the results of your portfolio or the money management you're receiving, you're more than welcome to call Rezny Wealth Management for a consultation. As always, we do manage larger portfolios, and consultation requests are for those of you who want to talk to us about our money management services because you are not 100% happy with how you're currently managing your own money or who you're currently utilizing. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. You know, one of the big concerns that often happens in retirement, and one of the concerns I hear from a lot of pre-retirees and retirees, is running out of money in retirement during retirement. And that should be a big concern. And why does that happen? Well, number one, your money's not invested properly. Number two, you're spending too much money. And number three, you're getting just plain bad financial advice from maybe a so-called advisor who's actually not managing your money properly at all, or it could possibly even be yourself. Remember, prepare the strategies around your retirement. What's your budget? Create a realistic budget, and you need to stick to it. One of the things that I find with most retirees, people that hire our firm, they've never done a retirement plan. Whether they're 80 when they hire us, when they're 45 when they hire us, we'll always ask, do you have a detailed written retirement plan that shows you how retirement will look under certain scenarios? Very few, maybe 1 out of 100 new clients that hire my firm actually has ever done a retirement plan. This is a problem because you really don't know the direction where you're really headed and where you're going to end up. By doing a proper retirement plan, which is what we do with our clients, we can then help guide you so you can make better decisions around your portfolio, your retirement, and it gives you what I consider the warm and fuzzy so you can see actually what the potential is for your retirement success. Remember, your retirement success is vitally important. Don't shoot from the hip. Have a plan, follow that plan, and make sure you implement that plan so that you can prosper for the next 20, 25, or 30 years during your retirement. Have it in an emergency fund, vitally important. Looking at your healthcare costs. I think a lot of retirees often realize, hey, healthcare could go up during my retirement, but sometimes they don't factor in enough. Social Security maximization is another big one. I have seen very few individuals that look at Social Security as a real tool, meaning when should you take Social Security? How do you optimize your benefits? What's the best way to take Social Security and at what time? These are strategies that are vitally important for you, the investor. Remember, once you take Social Security, there's no going back and changing it. So analyzing Social Security before you make a decision or working with a firm that can help you make that decision allows you to make a better informed decision that hopefully will be the correct decision that will benefit you years into retirement. Joe in Naples, Florida. What do you think about DAX as a way to invest in Germany? Joe, excellent question. DAX is an ETF. It buys German stocks. It's a basket essentially of German stocks. I will say this. I do not like any of the emerging market economies right now, and I do not like, even more so, Germany or the European economies. So what I'm going to say is this. If you look at the European economies in general, they have very slow long-term or no growth to their economies. Their economies really are in shambles. Lots of debt, very little growth. Remember what I talked about earlier. What actually grows in an investment asset? Earnings. If you're not growing earnings, chances are that stock price isn't going up. If you look at a country specific, and that's called a top-down approach, and that's how we manage money. We'll look at country specifics, whether it's Germany, China, the US, which country or countries are the best places of opportunity for a growing economy. Germany's certainly not it. I would say you're better off staying US-centric right now, and I don't see going into Germany anytime soon. Rob in Miami, Florida. Which investment sectors are moving up and which ones are down? You mentioned healthcare earlier this year. We continue to like healthcare, Rob, and the reason we like healthcare is actually it's one of the higher earnings growth sectors of the main sectors of the S&P 500. And as I talked about earlier, earnings relative strength. How fast earnings are growing in a sector or a specific stock usually will show up in price return. So if you're buying into sectors that have very little earnings growth or negative earnings growth, chances are you're not going to make money or your money's going down in value. Sectors or stocks that are specifically growing earnings faster than the overall S&P, which this year is projected around 6%, there's a high likelihood those sectors will outperform the S&P on average. So we do like healthcare. I mentioned earlier about technology, and I think those are two areas primarily that I think have a great opportunity within the U.S. marketplace. But again, look at all the different sectors. There's times you're going to own certain sectors, and for long periods of time, I think healthcare in general is going to be a long-term earnings growth story in the U.S. because people will need more and more healthcare over time, which ultimately will lead to healthcare profits. Linda in Punta Gorda, Florida. What do you think about the U.S. debt crisis and its impact on the U.S. economy? Linda, we've got a lot of debt in the U.S., and the debt is only increasing over time. At some point, our national debt is going to be a major problem. I don't think it's today, and I don't think it's in the next decade. But there's going to be a point in time that we need seriously to address our national debt. You can't keep piling more and more debt on, especially when interest rates are as elevated as they are today. It's going to have an impact. Remember, our government does a lousy job spending money. So whether you're a Democrat, whether you're a Republican, they've both overspent, and they've created all this national debt we have. It's going to have an impact. But again, I don't think it'll be immediately, but it's something for you that you really need to ultimately track and watch, because at some point, some of your investments may not make sense. You may want to raise cash. You may want to get more conservative. I just don't think it's in the next decade, but it is coming down the road. Ralph in Naples, Florida. Media and investment decisions. I recently received an investment newsletter claiming a market crash from budget and debt. Your thoughts? Ralph, I love the question. So think about this. You know, all your legacy media in general, the emails you get in your inbox, internet ads, what have you. How do they get people to click on those? They sensationalize a topic. Most news programs today are not news at all. They're basically glorified, hyped up little segments that basically sell advertising, and that's how most of these news services make money. Most news outlets are worthless. Most of these newsletters you get in your inbox are worthless. The commercials on TV about buy gold now because the world's coming to an end, or the dollar's not going to be the dollar. These commercials have been going on for decades. And the way they get you to buy gold or overprice gold is they get you emotional. So what I would say to you is this. At our firm, Rezny Wealth Management, we do not use any media outlets of general propaganda kind of stuff, which most of it really is. It's hyped up stuff. We don't use any of that in our thought and decision-making process when we're managing money. We look at really independent research that really drills down how economies of the world are doing, and ultimately investments then within those economies that we want to invest our clients' money. You should be doing the same thing. Again, the things that you see often on these news programs are worthless. Emails in your inbox claiming hyped up returns are worthless. Scare tactics, again, are worthless. You as an investor need to make better choices around your portfolio. Bill in Cape Coral, Florida. I recently was offered an equity index annuity by my advisor. He wants me to move half of my IRA into it to safely protect my money for growing retirement income. Is this factual? I know you hate annuities, but it sounds pretty good. No. Annuities are complete garbage, and unfortunately your advisor probably needs to make a house or car payment, so he wants to take half of your IRA and put it into an equity index annuity. Number one, you're not going to get inflation protection. You'll be lucky if that equity index annuity returns on an annualized basis over the next 10 years, 1 to 1.5%. That's it. Equity index annuities were manufactured by insurance companies, sold by so-called advisors who are not fee-only fiduciary money managers who only want to line their pocket with commission. If you invest in that equity index annuity, I'll guarantee you this. In 3 to 4 years, you'll realize you made the biggest financial mistake of your life. You'll realize what I'm telling you right now was 100% correct. When you go to pull the money out, you're going to pay some enormous surrender penalty to get all your money out, which is a huge mistake for you, the investor. Do not buy an annuity. Go to ReznyWealth.com, click on the Special Reports tab, and download for free why annuities are dangerous to your wealth and retirement. The carnage that these so-called advisors have done to you, the retiree and pre-retiree, by selling you these garbage annuities over the last decades is horrific. But unfortunately, the insurance industry is loosely regulated at best, and it hurts you retirees and pre-retirees alike. Conclusion. Retirees must stay informed and adapt about the economic shifts in our economy. You need to make changes to your portfolio in a timely manner. Remember that. The U.S. economy will continue to evolve. Be prudent. Make portfolio changes when necessary to your portfolio. If you're unable to manage your own money or the advice you're getting is just not working, call Rezny Wealth Management. Honesty, integrity, compassion, and competence. That's the difference we provide all of our clients. Again, call our office, visit our website, ReznyWealth.com. Let us help secure your family legacy and let us help you secure your ultimate retirement. Have a safe and profitable day.